to the presentation of the second quarter results of Minor International. Today we have two presenters, Kun Chayapat Paitun, Vice President of Strategic Planning, and myself, Jathatip Adunpan, Group Director of Investor Relations. For agenda, we'll start off with the first half performance recap, followed by hotel and mixed-use business update, followed by restaurant business update, and then other important information. First, I'd like to do a quick recap on our first half results. In terms of revenue, we reported revenue of about 18 billion baht, 10% increase over the same period last year. This was mainly a result of the improvement of all three business units. For hotel and mixed-use business, we saw revenue increase of about 6%, mainly from the improvement in the operation of the owned hotels, as well as management contract, and as well as the improvement of the Anantara Vacation Club sales. That was netted off with the Oaks performance. Although Oaks was doing well in Australian dollars term, but because when you translate it into Thai baht, and Thai baht strengthened about 6% against Australian dollars, we saw a little bit of dip in Oaks performance. And also, we've closed down two hotels, Anantara Baput in Samui and also Anantara Valley in the Maldives for renovation. So those two hotels will be closed for the next 2 quarters, so in second and third quarter of this year, and will reopen again during the high season in the fourth quarter of the year. And also, of course, we closed down the Hua Hin Marriott hotel since June of last year. So with that, we saw revenue increase of about 6% on the hotel and mixed-use business. On the restaurant side, we also saw revenue increase of about 14%, mainly from the improvement of the organic business of the restaurant business itself, and also because of the consolidation of Riverside, which we acquired 49% of since the end of 2012. And the last business, retail trading, also saw about 13% increase in terms of revenue, mainly from better performance of the fashion business, which is a higher margin business relatively to other businesses, and also because of the contract manufacturing business, which was in full operation in the first half of this year compared to first half of last year when it was affected by the flood, and therefore it was partially opened. In terms of net profit, we saw about 19% increase year on year in the first half compared to last year. This was mainly a result of the increase in net profit of hotel and mixed-use business by about 16%. Although we saw a slight decline of EBITDA in the first half of 2013, mainly because we closed the two hotels that we closed. But in terms of net profit, it was up by about 16% because the effective tax rate was back to normal rate in the first half of this year compared to first half of last year when Oaks went through some adjustments of their taxes last year. And for the restaurant business, we saw 21% increase in terms of net profit, mainly from the higher operating leverage of the restaurant business, together with the turnaround of the China business, which net profit became, the EBITDA became profitable in this first half of this year compared to negative EBITDA in the first half of last year. And retail trading, of course, because of the higher margin fashion business and also the contract manufacturing business as well. And if you remember, in the first quarter of last year, we also had some extraordinary gain, which was insurance claim that we received from the flood in the first quarter of 2012. So if we take that out, in terms of core net profit, it was up by about 25% this year compared to first half of last year. Now we go into detail of each of the business units. The first one is the hotel and mixed-use business. If we look at the system-wide hotel operations, this includes everything that's in our portfolio. Number of rooms increased by about 10%, while occupancy was flat year on year. ADR was down by 4%, causing the RevPAR to be down by about 4%. For the overall business, we saw slight negative in the RevPAR, mainly because of two reasons. One is because of the new management contracts that were opened during the year. The newer management contracts, of course, give us lower occupancy and lower ADR in the beginning of their when it first opened. So that brought down the overall average. And the other thing is because of the strengthening of the Thai baht. If you look at this quarter compared to second quarter of last year, Thai baht strengthened by about 4% compared to US dollars and by about 6% compared to Australian dollars. So those two factors resulted in decline in RevPAR. But if you look organic, excluding FX, meaning just like-for-like hotels, occupancy was up by 2%, ADR was up by 1%, and RevPAR was up by about 5%. But there are quite a few different segments in our hotel business, so we'll try to go deeper into each of the segment because there are different dynamics that drive the growth of each of the segment. So the first one we'll talk about is the owned hotels operation. If you look at the owned hotels, in terms of revenue contribution, it's about 46% of our total hotel and mixed-use revenue. So this is the biggest part of our hotel and mixed-use business. If you look at this segment, you'll see that in terms of number of rooms, it was down by about 6% compared to the same period last year, mainly because we closed the Hua Hin Marriott in the third quarter of last year. We added 2 new hotels in Hoi An and Quy Nhon in Vietnam. And then we also closed the Ba Phut in Samui for renovation. And in terms of occupancy, it's actually up system-wide for the owned hotel. It's actually up by about 3% year-on-year. ADR is up 5% and RevPAR is up by 10%, mainly from the improvement of all of our brands, Anantara, Four Seasons, Marriott, and St. Regis. So likewise, if we look in terms of organic, excluding foreign exchange impact, occupancy went up by about 5%. ADR was up by 6%, and RevPAR was up even higher at about 15%. Now, if you look at the expansion plan of the owned hotel portfolio, over the next 3 years, we're seeing about 10% plus or minus in terms of expansion, in terms of number of rooms. Geographical focus remain in the countries that we're familiar with, that we've had experience in. So that's Thailand, of course, Australia, Maldives, Sri Lanka, and Vietnam. This is actually pretty much in line with what we've been telling investors in the first quarter of this year. So we've opened the Vietnam hotels, the 2 hotels we talked about. We're opening Anantara Layan in Bangkok, in Thailand, in Phuket, by the end of this year. So this is the hotel that we acquired called Buntarika that's being renovated as we speak today. And in 2015, we're looking at opening our flagship Avani in Bangkok. In Australia, the Grand Hotel is still on schedule, so we'll be opening that next year. And in Sri Lanka, we're opening 2 hotels, Ambalangkoda and Sri Lanka, in the year 2015. Now we turn to the second biggest segment in the hotel and mixed-use business, which is Oaks. Oaks, in the first half of this year, contribute about 27% of the total hotel and mixed-use revenue. And in terms of number of room, we're seeing about 4% increase. Occupancy is quite stable at around 75-76% compared to the same period last year. ADR in terms of Australian dollar was flat at about 157-158 Australian dollars per room per night. And RevPAR, of course, is about flat as well. But because of the strengthening of the Thai baht, if you look at in terms of Thai baht, ADR was down by about 7% and RevPAR was down by about 7%. So this is actually as expected. As we've told investors earlier, for Oaks, we're not looking at increasing much of either occupancy or ADR, because in terms of ADR, we're already running at about 75 to 80% occupancy, which is already high. But in terms